Hi, Abdullah here, and I'm going to explore opportunities in gold and silver amidst the market sell-off that we're experiencing today. So I want to look at gold in different types of economic environments and in different types of sell-offs throughout history. So just looking at gold in a deflationary environment, this is the 1920s to 1940s, so this involves the Great Depression. And what happened there was amidst the market sell-off, the US experienced deflationary pressures. There was a run on the banks, and there was a big worry from the White House at the time, Franklin Delano Roosevelt. What he did was around the early 1930s, he delinked the dollar from gold. So in the past, the price of gold was fixed with the dollar. It was around $20 an ounce. When Franklin Delano Roosevelt decided to delink the dollar, and he took extreme measures to do so, the the dollar depreciated, uh, but gold rallied massively from around $20 to around $35 an ounce. Um, Homestake Mining is a gold mining company, one of the largest in the US at the time. Didn't have a very good start to the 20s in the decade, um, falling from around $80 to below $50. But then what happened was a steady increase, and from delinking the dollar from gold, and gold's rally from $20 to $35 an ounce, Homestake appreciated massively from below $50 to over $544 and $544 a share, and this was all in the span of around 10 years. So gold miners are leveraged to the price of gold. So there's a bigger opportunity there if you believe that the gold price will be increasing. So just looking at gold in an inflationary environment, the 1970s, this was a period of stagflation where there was high inflation but very little economic growth. Average inflation, average CPI in this decade was 7.4%, more than twice the 2.5% average run rate in the US. Gold spiked up massively here from um, over just a bit over $200 to above $1,000, while the Dow Jones was basically flat for the whole decade. Now, looking at the dot-com bubble, we're witnessing a similar pattern here, where gold initially sells off with the market, but then gold reverses course and rallies as the market continues its downward trend. So the Dow Jones here, from peak to trough, down 30.9%, while gold drew down initially 8.5%, but then rallied 43% from its trough. In the global financial crisis of 2008, this was a great performance for gold, reaching all-time highs of 1800. What happened here was the Federal Reserve engaged in quantitative easing and printing money. So quantitative easing is printing money at a very large scale, and basically giving access to corporates, and giving access to the government, giving credit access to the government, making interest rates very low. So gold and interest rates usually have a negative correlation, and that was a massive opportunity in gold. Huge rally to 1800. We could possibly be seeing something like that going forward in gold because of what the Federal Reserve is doing today. They're going to um, do a bigger quantitative easing package than what they did in 2008. The government is talking about sending paychecks to people, to households. We expect government to incur massive amounts of debt for which they will require very low interest rates for a longer time. This setup is very bullish for gold. Now, another way to play gold is the opportunity in silver. What's interesting is throughout history, from the 1970s until today, the average of gold to silver price is around 65 times. So, the appropriate price for gold is to be 65 times more expensive than silver. What we see today is that this ratio is around 120 times. So gold has rallied massively, but silver hasn't done much since then. We see that the gold to silver ratio shows some signals. For example, when silver rallied massively uh, off the back of uh, the global financial crisis, where gold rallied massively, silver did exponentially better than gold. But the rally in silver was so steep and so high that it brought the gold to silver ratio to below $65 on average. That was a signal to sell, and duly it went down. Silver went down from its all-time highs to around where it's trading at today, around $16 an ounce. Um, a counter argument for silver would be that silver is actually a commodity for when there is economic growth, because it has a lot of industrial uses. It's used in semiconductors and medical equipment, in gaming and household appliances. So demand for silver will actually fall amid the financial crisis. But we can also say that silver is a smaller denomination of gold, and money managers usually, when they perceive risks in the market and start to price these risks in, usually they seek the safe havens like gold. And that is the first place where they look, because it's quite liquid, it's easy to buy, whereas silver is a secondary order of gold, so less liquid. And once you see demand in silver to acquire silver, you'll see a very aggressive ramp up here. Also, with what's going on in QE, last QE, and amid the global financial crisis, we saw a massive rally. We could expect to see something similar to some similar going forward. We like gold and silver, and this is a point where we're looking to add to our positions in silver. Another way to play the rally in gold prices is to look at gold miners. The HUI is the gold mining index, so it's an equally weighted basket of gold miners who are not hedging their exposure to gold. And we see a similar pattern to what gold had done, although these we have to remember that these are stocks, so they come with a large degree of volatility. So in the global financial crisis, it took gold miners 227 days to go from peak to trough. That is a much faster sell-off than the S&P 500, which sold off. It took 517 days to go from peak to trough. And the sell-off was much more severe for the gold miners, around 70%, versus the S&P around 56% from peak to trough. But what happens afterwards as gold appreciates, because what we saw that initially is that gold first of all sells off with the market initially, but then outperforms massively. So we see this similar pattern with the miners. The miners trough, uh, they reach the trough much sooner than the S&P by around 250 days. But then 200 days afterwards, the gold miners achieved a 160% return, whereas the S&P 500, 200 days afterwards, achieved a 30.5% return. Now, that's not saying that this is all the return that you can get. It's the HUI is at that time was a very volatile holding to have. So you would get bouts of volatility, but this represents over four times your investment within a very short span of time. Today, what we see is that the gold miners and the stock market are moving in tandem. So on days where the market is down, gold miners are usually down. Um, but what we do see, and that is interesting, is that the gold miners have been outperforming the S&P 500 year to date, but has been underperforming gold. So I believe that if you see a very strong rally in gold, that is when you could see some strong movement in the gold miners. That's it from me. I hope this was helpful and piqued your interest. If you have any questions, please feel free to reach out and join in the discussion.